Have you been wondering when to collect your Social Security benefits? Most people say wait until you're 70 because you can collect the highest benefit, and that sounds great, but I'm going to show you when that's actually a huge mistake. I want you to meet Don and Lisa, who face this exact same dilemma. Now, they are age 65 and 63 respectively, and their primary goals are to reduce their lifetime tax bill, optimize their Social Security benefits, and they'd love to leave a legacy for their children. So what we're going to do is take a look at their total assets, right? What is the totality of their financial situation? And so you can see they have assets of about $3 million. $1.9 million of those assets are in investment accounts. And what you'll see here is that Don and Lisa, they both have pre-tax retirement accounts, AKA IRA accounts. And then they also have a joint taxable brokerage account. They have some cash at the bank, around $20,000 in like a CD. And then they own their home. That's worth about $1.1 million. Now, they do have a mortgage. It's about $150,000, and that's projected to be paid off within the next couple of years. Now, on the expenses side, their goal and their target was to spend about $10,000 per month after taxes, after their mortgage has been paid off as well, or after their mortgage payment, I should say. And so there we go. We can see that mortgage payment. And then they also wanted to do some traveling. Now, we put that traveling at about $12,000 per year. And of course, that is adjusted for inflation. So it's not going to be $12,000 per year, 5 or 10 years from now. And we had this projection in terms of their vacation spending going to around their mid 80s. They felt like that was the most reasonable, since most people, once they get into their mid 80s, often slow down and, usually just don't travel as much. We're also factoring in taxes. So we're looking at ordinary income taxes, long-term capital gain tax, and state tax as well. You'll see here that their long-term capital gain tax and ordinary income tax is actually at zero. We're going to talk a little bit about taxes because that's a really big consideration of when to take Social Security benefits. And I'll even do a tax analysis to show you guys exactly what that looks like. Now, in order to create all this, income and pay for all of these expenses, we have to create income from somewhere. And so they do have a rental property, and that rental property creates about $1,000 a month net after expenses. And so in the first year of retirement, right, they're going to have this rental income, and then they have to create income from other sources. And what we're showing is that's going to equate to portfolio withdrawals of about $145,000 per year. Now, of course, Social Security hasn't started yet, and that's the big decision that we're trying to figure out today. And so the current analysis we wanted to do is, based upon the advice that they've heard from other sources, which was start Social Security at 70. And that's what you'll see here is that little thing at the top wiggles there. You're seeing that's when it's saying Social Security benefits are projected to start. And one thing I failed to mention when I was talking about their investment accounts were that the overall allocation of their investments is about 75% stocks and 25% bonds and cash. And of course, as you may know, stocks are really designed for that long-term growth, and bonds and cash are designed for a lot more stability and allow you to create that monthly systematic income that you need. And just to break down those percentages in terms of dollar amounts, on a $1.9 million portfolio, what that means is about roughly $1.4 million are in stocks and about $475,000 are in bonds and cash. And that's incredibly important, as you'll see in just in a moment when we get into how are they going to actually create this income need before their Social Security starts, if they did decide to wait until 70. So why are we even having this conversation to begin with? Well, of course, they were told the generic advice to wait as long as possible to take Social Security. And of course, the longest you can wait is age 70. And that's because every year you delay taking your benefits beyond your full retirement age, you actually get a boost in benefits, roughly 8% for the remainder of your life. And that's huge. Where can you get an 8% guaranteed return on your money? But there's something else that was really interesting. On the other hand, they were also told to start taking benefits early and then invest the money for a higher return. And so, they were really confused, and I don't blame them. And the reason there is so much confusion is because people don't know how to analyze it the right way within the context of their entire financial plan. So here's how we made the right decision for them. Now, again, remember these facts in terms of their investments, the allocation, in terms of how much is between stocks and bonds, and all their different income sources. And so what we're going to do is we're going to take a more granular look at their income to say, where is this actually coming from? Again, going back to that Social Security at age 70 scenario. And what we'll see here in terms of expenses is that yellow line, this is just a visual representation of their spending over their lifetime. And what you'll see here is that their mortgage payment is expected to be paid off by 2030, right? And of course, we're accounting for vacations at $12,000 a year adjusted for inflation, and then $10,000 a month on just pure discretionary living expenses. And of course, that is adjusted for inflation as well. I talked about taxes earlier. We are accounting for lifetime taxes, which I am going to show you more details on that in just a moment. But then when we go to the income sources, we can see not only what income sources can we expect now, but what income sources might we expect in the future, and where do those income sources need to come from to meet your needs, accounting for things like the mortgage being paid off in a couple of years. And so what you'll see here is that portfolio withdrawals are about $145,000, rental income about $12,000 a year net of all the expenses. Lisa did have a pension that was going to start. Now that pension we were expecting to start that when she turned age 65. But the main thing I want to draw your eye to are the portfolio withdrawals that you'll see in this column right here. You'll see in that first year, the withdrawal is about $145,000. And then it really, it kind of just stays the same. That pension is just not enough to close the gap. And this is a lot of money that they have to take out until Dawn starts Social Security at age 70. And then a year later, when Lisa starts her Social Security at age 70 as well. And so this is actually creating a problem for their cash flow, because how we want to think about it is like this. If that first year withdrawal is $145,000, well, maybe 1 year of taking that amount of income may not be a real big problem, but this is multiple years of high withdrawals that we have to account for. And I want to remind you of something we talked about earlier, which was their portfolio allocation, right? 25% of their total portfolio was in bonds, about $475,000. So if we take that $145,000 withdrawal need and we divide that into the $475,000 of bonds and cash that they have, that means they have about 3 years worth of withdrawals in those more stable cash and bonds. And that can actually be a bit of a problem for them. For the clients that I serve, I really like to see them have around 5 to 7 years worth of withdrawals in, like bonds and cash, depending upon risk tolerance. And this allows my clients to ride out market storms and create that reliable income even when markets are choppy. And again, if their withdrawal rate was high for a year or two, that may be fine. But having that high of withdrawal until the age 70, it's going to be a bit of a stretch, and it's going to put a lot of pressure on the portfolio. If we have major bumps in the road and markets drop, it could cause them to massively cut their retirement spending to make sure they don't run out of money. And that was just something that they were not comfortable with. Again, I have other clients that have higher risk tolerances. They're willing to accept more risk and willing to make more adjustments. But for Don and Lisa, one of their goals was to have as little income adjustments as needed throughout retirement. So again, one of the big problems of waiting until 70 was the amount of time until benefits would kick in, and that put a lot of stress on the portfolio. But there is another big problem. Remember, one of their primary goals was to reduce taxes, and their current plan to spend from the taxable account and then tax deferred money could put them in a poor position. And now what we're going to do is we're going to take a more granular look at their taxes over their lifetime. And specifically, we're going to take a look at taxes within the first couple years. And again, this is assuming they were to not start Social Security benefits until 70. So we got to make, the first couple years pretty much just come from the portfolio. You'll see in the early years, most of their income, of course, is going to come from the brokerage account or that taxable account. And so their tax bill is going to be really, really low, right? And that's because a lot of their income are basically non-existent. And that's because all their income's coming from long-term capital gains. But I'm going to point you to the year 2027 because that is when their brokerage account is expected to be fully depleted. And then they're going to be relying upon their IRA account to take withdrawals and meet their needs. And they still have to do that for a couple more years until Don's Social Security starts in. So what we'll see here is that, the brokerage account basically gets wiped out this year, and then they're fully relying upon their pre-tax retirement accounts to meet their needs. And here's how this ties into the Social Security decision, because our tax code is not so nice with Social Security because, yes, Social Security can be taxed at the federal level. As you'll see here, you only need to have what the IRS calls combined income of $44,000 for a married couple before up to 85% of your Social Security benefits are taxable at ordinary income rates, which, as you know, can get pretty steep pretty quickly, right? It starts at 10%, but goes all the way up to 37%. So each additional dollar making more of Social Security benefits tax, and then it's taxed at ordinary income rates, is what's known as a tax torpedo. Every single dollar of additional income that you make, more of your Social Security benefits are taxed, which are then taxed at your ordinary income rate. Now, I'm sure that you can imagine with large Social Security payments and pre-tax withdrawals that they'll have in their 70s at least, this could create really a pretty big tax bomb. And by the way, this is the kind of strategy that we help our clients with all day long. So if you're interested in learning how our team of retirement planners might be able to help you in your situation, you can always schedule a time to talk with one of our CFPs in the description down below. So now what we're going to do is, instead of waiting until 70, we're going to take a look at a situation of starting Social Security at their full retirement age rather than, again, waiting. Now, we didn't necessarily recommend they start benefits now because, as you may know, if you start benefits before your full retirement age, you're actually going to have a reduction in your benefits. But if you do wait to your full retirement age, then you at least get your full entitlement amount. So now what we're going to do is we're going to go back and we're going to take a look at the situation at which they start benefits at, let's just say, full retirement age. I've just rounded up to 67 to keep things really simple. But if we go to their cash flow analysis, you'll see it looks pretty darn similar. But the difference is, of course, Social Security has been pushed forward in terms of the timeline of when they take benefits. The withdrawal need in the first year is, of course, the same as the situation of them taking benefits at age 70. But the difference is that the next year, Don will begin benefits. And then by the second year, his full benefits have really kicked in. And what you're seeing here is that takes a significant amount of stress off the portfolio. And then again, in the following year after that, Lisa starts her benefits, further taking stress off the portfolio. And so what we can see is that starting at 67 or their full retirement age, rather than 70, doesn't change the first year of retirement, but it changes the following years really quickly. And it very quickly takes some stress off the portfolio, adds a base layer of income, and it's going to reduce the probability of them needing to adjust their income if markets are maybe not so favorable in the early years of retirement. And of course, what we showed them here is that even by taking at age 67, they're not necessarily going to need to take less income over their lifetime. We can still create the income that they need, that $10,000 a month of pure living expense, the mortgage payment of $2,000, and then the additional, about $12,000 a year adjusted for inflation for traveling. Now, believe it or not, taking it at 67 is actually a little bit more tax efficient as well. Now, something we do with all our clients is analyze their tax return. So we actually did a mock scenario of what their taxes might look like in 2025 and 2026 if they were to start benefits at their full retirement age. So what I'll do is I'll pull up our tax program. And again, we do this for all of our clients to just analyze not only what does their tax situation look like now, but it also helps us kind of project in the future, use the best estimates that we can to say what might we expect to pay. And so in this situation, what I did was I filled in, really just some estimates in terms of how much tax exempt interest might we earn in the investment accounts, because in a larger brokerage account, we'd probably be using some municipal bonds. I also put in here just some qualified and non-qualified dividends. Of course, in 2025, like I mentioned before, Lisa will be starting her pension, right, at age 65. So I have that here. And then when Dawn starts his Social Security next year, it's not going to be a full year. It'll be a partial year. So I have that in here as well. Most of their income is going to come from their brokerage account, and that's what's reflected here as long-term capital gains. And then I'm also factoring in their rental property here in terms of the net of what they make. So after we factor in all these different income sources, and I just assume they take the standard deduction to keep things simple, what you'll notice here is that their total tax in 2025 is actually projected to be zero. We've talked about this in previous videos, but this is because of the long-term capital gain bracket. There's a special bracket where you can actually realize quite a bit of income and pay 0% federal taxes. Now, I also looked at 2026. I kind of used some of that information and moved it over. But the big difference was that the taxable pension amount was expected to go up because, again, now Lisa has a full year of the pension under her belt. And then we also have a full year of Dawn's Social Security as well showing up here. In terms of the long-term capital gains, as that account starts to dwindle down a little bit, less is taxed at that long-term capital gain rate. Schedule E, which is basically the rental income, is going to be about the same, maybe adjusted a little bit for inflation. And again, what you're going to see here is that their total tax would be about $2,900. And that's at least the projection. And part of that, you'll notice here that the tax bracket is going up to 15. Part of that is because of the Tax Cuts and Jobs Act sunset. That's planned for the end of 2025. So we are accounting for a situation like that and how that might impact their taxes. So that was a granular look at their taxes in years 2025 and 2026. Really, again, the 2 years in which they would start Social Security if they did start at their full retirement age. Now, I'll tell you, the strategy of starting their Social Security benefits at their full retirement age did reduce the potential legacy benefit to their children. It was a little bit lower than taking at age 70 because we're going to be taking a little bit more out of the portfolio later in life because of that slightly lower lifetime Social Security benefit. But nonetheless, this was more important to Don and Lisa, right? To have that reliable income that was less likely to be adjusted was a higher priority than ensuring the absolute maximum value in terms of inheritance to their children. And this is why financial planning is so important. When you prioritize what's most important to you, then you can build a plan based upon what's best for you. And that's why I love doing this with folks and helping them understand what is possible. They don't have to be put into some cookie cutter plan. It can be designed for what they want to optimize and make sure they have the best retirement possible. Now, you still might be thinking to yourself, well, their tax bill is going to be through the roof once their taxable account is depleted, and they have to begin required minimum distributions. And you're right. But I made another video where I showed you how we solved a problem just like this. And I answered the question of how much you can expect to spend in retirement with a $2.3 million portfolio. You can watch that video right here. Once again, this is Alex Okagawa, partner and financial advisor here at One Degree Advisors. And if you're interested in learning how we help our clients gain confidence in their retirement, visit our website at onedegreeadvisors.com.